Good morning, also from my side. Yeah, one more sentence to me. I am working for DWS since 15 years, and I'm responsible for the ESG advisory to all our institutional as well as retail clients. And yeah, I'm glad to participate this panel. And we had a pre-call already, and this was longer as expected. So I hope we have a good discussion around the next 30 minutes. So it would be great if you both can also shortly introduce yourself. And Marion, you want to start?
Sure. So good morning, everyone. I'm also delighted to be here with you. So a quick word of introduction. I've been working for AXA Investment Managers for the past 17 years, and I'm now heading the active fixed income team for Europe and Asia. So the team is basically made of 30 portfolio managers, and we invest in credit, inflation, emerging markets, Asian credit for third-party clients. And of course, ESG integration has been a reality for the entire teams this year, and we expect much more for the years to come.
Davide.
Yes, and let me echo also my pleasure for being here and be participating to this conference. I joined Eurex and the fixed income product development team in 2018. Within our team, we study the financial market ecosystem in the fixed income space, trying to identify macro trends and ongoing structural changes in the financial markets. In this context, our job is mainly to find new opportunities in the listed derivatives from a listed derivatives perspective and to maintain and adapt our existing product suite. Within the team, my area of competence is across linear rates and indices, and more specifically, I'm leading the research and implementation of new products in the fixed income ESG listed derivative market.
So thanks a lot. And as Marion already said, I guess we must not talk about the reason or the why we should invest into ESG considerations. So it's more the question how we do it and what are maybe the topics for the next year. And one question as a starting point, really, why is it so late that we are looking at ESG considerations in the fixed income space in comparison to the equity world? So maybe Marion, you'd like to start?
Yeah, and actually, I'd like to start by answering, actually, we haven't been late at AXA Investment Managers because we've actually been integrating ESG criteria for some time. And actually, we launched our first fixed income fund with a deep ESG integration, actually best in class approach in 2002. And of course, this is coming from the fact that we are a French asset manager. So I think, we've been pushed quite hard by our clients based in France, by the regulation as well, by the expectations that are actually quite strong in France. And also, I think, the fact that we've adopted ESG criteria in fixed income very early comes from the fact that we are a very large fixed income house. Being the asset manager of the AXA group makes us one of the largest investors in fixed income. So, we had to be early adopters of ESG integration in fixed income.
Yeah, on this side, over the course of the year, we have also have some research and conducted some surveys with clients and specifically end investors such as asset managers and pension funds. And in this regard, what we found is that the relative lag of fixed income investing into ESG principles and ESG strategies was, let's say, due to some challenges that were experienced by fixed income investors in this space, and more specifically due to the larger investable asset universe that you see in the fixed income space. In particular, we need to consider and to make the distinction between listed and unlisted companies and securities. And in the fixed income world, a large part of the assets are on the unlisted side, for which financial and non-financial disclosures are more difficult to obtain. And in this sense, data collected for non-financial disclosure, specifically for ESG considerations, are more difficult to obtain and, of course, are less standardized. This was one of the reasons why we saw that we collected from investors that have the fixed income side to lag behind the equity world. On the other hand, we also need to consider the different nature of bondholders with shareholders, where, of course, shareholders are able to steer the ESG policy of companies thanks to their right to vote. And this is something that fixed income investors can do, but it's more difficult to do. So the fixed income investors can leverage and can steer the policy, of course, of companies with their decision of investing or not investing in a company, which is something a little bit more subtle than being present and being able to steer policy with the right of vote. So this has also been a factor that have hindered the growth in the of ESG integration strategies in the fixed income market, as it is more difficult, of course, to steer the ESG policy of a company just via your decision of investing in a company or not. However, and I bet Marion will be able to elaborate more on that, larger asset managers have been able to increase and to create strong engagement teams with whom they were able, of course, to have, let's say, a stronger voice in the decision of companies regarding the ESG integration. Something that smaller asset managers, of course, are usually not able to do.
Yes, let me jump in and echo what you've just been saying and maybe illustrate some of the points that you made, in particular on data. For sure, this is really tricky to address because, as you said, the investable universe is wide, is massive within fixed income. Just to give you a few numbers, on credits, our own methodology covers 8,500 issuers. And that's roughly more than 90%, of a world index in investment grade credit. So, in terms of coverage, we are getting there, but we're getting there because, as you say, we're a large asset manager and we have, enough resources to go and pick a lot of raw data and to compute those data into our own methodologies so that we come up with our own ESG scores. And on the sovereign front, we have also an ESG methodology that allows us to come up with a score for something like 100 countries. That's 98% of the global JP Morgan index. So as you were saying, I think that the tricky point is to gather data, and then gets back to your point on engagement with companies. The more we engage with companies, the more we raise those questions when meeting ourselves, portfolio managers, with the issuers, be it sovereigns or corporates. When we raise those topics, when we make the points of the importance of those data to us, then they get the importance of releasing, any data on human capital, business ethics, corporate governance, all the data that we are going to be using as inputs into our methodologies. So I think this is a very complex topic. As you were saying, the coverage issue is an important one, is remaining an important one, but we've made a lot of progress, and engaging with companies within fixed income makes a big difference, and also makes our job and investing makes a lot of sense for us as investors.
One short question. Do you believe it is enough for an investor to rely purely on external data, or do you see that there must be an additional proof of portfolio managers or engagement teams?
The short answer is no, I don't think it's enough. The longer answer is I think you've got to combine both. You've got to combine, qualitative inputs into your investment process. So we've been talking about scores, but it's not only about scores. You've got a whole bunch of KPIs, carbon intensity, water intensity, and so on. And those data are some data that more and more we are getting familiar with, and we do have access to them in our front office systems. So for portfolio managers, this makes a big difference, data. But you're right, that's not enough. And more and more, we engage on that topic with our credit analysts and themselves and ourselves. We also engage with, the issuers on that topic. And at the end of the day, you also want to invest in those issuers which are going to improve their ESG metrics, not only the best ones, right? You also want to detect the issuers that are making really strong efforts to improve their metrics in that respect. And for this, you need to get qualitative inputs from your research teams, definitely, and from your portfolio managers, and you need to engage with companies at large.
So in this case, the scores that, let's say, would be used for the evaluation of a company's ESG profile, since, let's say, the scores are based on data that are released by the companies, are they not forward-looking, and therefore are they not useful to understand the which are the companies that are let's say going to make a transition?
I think that's a good question to ask, because an ESG score can give you a good picture of the current situation. But as a portfolio manager, you want to invest in the future, so you want to detect the trends. So in that respect, ESG score is not enough. So you need to get more information, more qualitative inputs, and definitely you also need to make sure that in terms of controversies, for example, more and more we tend to exclude, those issuers who are going to breach UNGC principles, for example. So you want to have a strong vigilance on those extreme tail risks, because at the end of the day, ESG risk monitoring is about this, excluding tail risks in ESG, right? You want to remove those risks from your portfolio. And this is where you need to be really forward-looking. You need to make sure that you're going to be avoiding those risks. It's like, in fixed income, avoiding default. You also need to avoid a large unexpected violation of a UN principle.
And we observed these tail risk in the past for single companies, and currently we observe these tail risk even for entire sectors, due to regulatory changes, due to the changes of our society. So I guess everyone is aware of our goal to be carbon neutral in 2050, and this is a common sense for our investments, even for us as investors. And so this is not a trend. This is maybe something where we know that will happen. And the question is how fast we adopt to this new normal. But we started this discussion from the view of an investor, and we started with data, and you explain the first impact on investments. What are other challenges, and what are your solutions by putting ESG data in consideration of your investment process?
I think some of the challenges are really the diversity and variety of challenges that we have in front of us. And what I find interesting is the development of clearly almost a new asset class that we've seen over the past few years is impact bonds. And for example, it's very interesting to be using and to be investing into those green or social or sustainable bonds in your portfolios, because they're going to be boosting, your KPIs, your ESG related investments. So I think, the way we've evolve our investment process is that we are more and more taking into account these developments in this new quite niche market, and that's mostly for European investors and issuers at the moment, but we are expecting quite a lot from the US now with the election of Joe Biden. But I think, in our investment process, we've adapted it to these new trends, and now we totally incorporate the possibility to invest in green, social, sustainable bonds, and we do for all our sustainable strategies, all our ESG integrated strategies, and of course, our impact strategies.
I have a question here, if I may. In order to really scale up this type of investments, there is the need of standardization. There is the need of common standards across Europe and potentially across the world. What do you feel and how do you think it is going to evolve, this standardization process? Because of course, it has started some time ago with the green bond principles, and now the ICMA has published the social bond principles and the sustainability bond principles. Where do you see it going, and how do you think it's going to affect your decisions in the ESG, in your ESG considerations?
I think those, standardization of principles for social, green, sustainable bonds have been really extremely positive for the markets, for the developments, both for issuers and investors. So it's a clear proof point that we need this standardization to make, everybody more comfortable with these instruments, both in terms of use of proceeds and reportings. So I would, advocate for a similar type of standardizations for other KPIs. We've been talking already about ESG score, but there, you still have massive differences between asset managers on internal scoring methodologies. And I'm not blaming internal methodologies. I think they have a lot of value in increasing, the possibility of coverage, for example. But at the end of the day, for an investor, you could invest in a similar strategy with two asset managers and coming up with two different ESG scores with kind of similar assets in there. I don't think it helps our investors to have such a discrepancy in methodologies. So I would be a strong advocate to get something much more standardized for kind of basic, KPIs like ESG scores, carbon intensity, water intensity, and so on.
Yeah, and I strongly believe that not only principles, we need a taxonomy for some of these scores. And as you said, carbon intensity, the question is how to measure it. Even the regulator is not completely clear if you like to do it on scope 1 and scope 2, or do you even look at the products you are producing and the carbon intensity of these products. Some are also looking at avoided emissions due to new concepts. And here, as Marion said, we need a clearer taxonomy of this.
Mm-hmm.
Not very often that investors like to observe this, but here I guess it makes everything a little bit easier. And we must be able to compare investment styles, and we must even compare the quality of portfolio managers. Yeah, so this was its typical market cap weighted index was always for all the approaches we deliver. We need something here, even in the ESG space.
To echo the standardization issue, of course, for Eurex as an infrastructure provider and a provider of listed derivative products, it is important for us to see standardization in the ESG space, and more specifically standardization of ESG strategies, in order for us to be able to offer effective listed derivatives in this space, which can effectively address the needs of asset managers. And maybe in this regard, of course, Eurex and other exchanges have futures on, in this case, equity index. But I would like to take this example on the equity and index side to maybe ask a question to Marion in regards on the tracking error of the indices, right? On the ESG space and from an active manager's perspective, what is more important, to have an ESG index which has a low tracking error to the benchmark one, or to have an ESG index which have a completely different risk return profile from the actual benchmark?
Well, that's a good question. And to be honest with you, we haven't seen a massive switch towards ESG indices yet. This, is still to be seen. And, we're working at the moment on large RFPs, and where, some investors are specifically asking us to build portfolios with ESG indices. But to be honest with you, those have a cost. And I think so far the investors would like the asset manager to come up with, an alpha and an active management, and actively integrate ESG criteria to deliver performance above a traditional benchmark. At the end of the day, this is what they expect, because they're convinced that the ESG integration is going to provide some long-term value to their portfolios. So far, we haven't seen a massive switch towards ESG indices. But to get back really to your question, I think what we would need as investors, as asset managers, but also for asset owners, we would need to have, different risk profile for all these ESG indices. And at the moment, I think we do not see enough differences and strong rational and very strong criteria in between the two different categories of indices. And I'm sure, this will be one of the developments for the year to come, but it hasn't materialized yet. So at the moment, really, the investor community is really much more expecting us as active asset managers to make those decisions, investment decisions, compared to traditional benchmarks, rather than use, ESG indices.
Exactly. So I currently we observe that most of the ESG targets of our clients are able to manage with a small tracking error against a traditional benchmark. But this is not the answer to your question, because I strongly believe in the future, even to regulator, even to the classification of investments into different articles, we will observe that there are requests for both parts. We will observe the classification for core investments with a low tracking error, but the regulator also asks for impact investments. And this definition is definitely something where you exclude more than 40% out of a typical traditional investment universe. And this is not possible with a tracking error calculation, because the strategic impact due to the integration of ESG characteristics is too high. And then this is a question to the industry, and we discussed it already. So is it something that all the asset managers are providing with their expertise and with their solutions inside the products? Or is it, technology platforms, index provider who have the right answer to all the different future requests? So, and this is a very important step. Currently, we are advising everyone to start with this consideration. I guess there is not a global sense to it. There are regional difference. So even in Europe, it's completely different questions. If you're talking to someone in the Nordics or in French, in comparison to even Germany, we are a little behind that discussion. And even globally, it's difficult to find there, one clear answer. What is the appropriate new benchmark for all our investments?
Definitely, there's not one single fit everybody's, requests. So I think at the moment, probably, we've been customizing solutions for all different types of investors throughout the world. And as you've been mentioning, the regulation has been extremely different, and the role of regulation has been extremely different in some countries. I mean, the AMF, for example, over the past few months, we've been working with the new regulation from AMF, and it's clearly pushing asset managers towards one direction. But other regulations are coming up with slightly different tilts. So I think at the end of the day, we still live in a very customized world, and we need more standardization.
So, one more question would definitely why we believe it is so important to consider ESG criteria. So we talk about a little bit, the tail risk management, and maybe even the development that everything started with exclusion. And you shortly also explained that we maybe do it together with the investments, so to be part of that transition. So maybe a broad overview why we believe this is not only a small trend, this is really mainstream to look at these criterias.
I think what we're doing more and more is, as you've just mentioned, at the beginning, I think everybody's been excluding, some issuers. We've got all of us exclusion policies which differ, but at the end of the day, we came up with the first approach of exclusion. Then on the totally other spectrum, you've got the best-in-class approach that, I mentioned the fact that we launched our first fund in 2002 and with a best-in-class approach because it was probably easier to understand and easier to identify. And I think now we are coming to probably an approach in between, which makes a lot of sense. It's more trying to get our portfolios sustainable. So it's not only purely excluding some issuers, it's engaging with issuers, it's also investing in those issuers where you do expect them to make significant progress towards ESG. So this is, I think, we are probably now getting to a stage where all these ESG investments makes a lot more sense, and we probably have a better understanding now of qualitative, quantitative inputs to make those proper steps.
Exactly, and so I can not imagine any case where we adopt something in that pace. So this discussion 3 years ago would be completely different to today. And so, yeah, I see that we have only 3-4 minutes left. So maybe an outlook or a question for you both. Eurex as a trading infrastructure provider and AXA as an asset manager, mostly on the fixed income side. What is your agenda for 2021, your outlook, and what do you think, what is the next development we will observe?
Do you want to start, Davide?
Yes, sure. On Eurex's side, I mean, as mentioned in the beginning, I work in the fixed income department, and we are doing research on ESG in fixed income, especially looking for the introduction of ESG fixed income derivatives. However, as also said, there are several challenges specifically related to the standardization on our side. And as listed derivatives are standardized derivatives, of course, we feed off standardization. Nevertheless, we try to identify themes and principles in the ESG space that can be standardized. And even though I cannot say much about exactly what we are working on at the moment, we have been developing some listed derivative solution in the fixed income ESG space that we would like to promote within the next year and within the years to come. And of course, as long as standardization develops in Europe and globally, we see more and more opportunities for ESG listed derivatives to establish, and therefore for more standardization in the ESG field to thrive.
And maybe on my side, the agenda for next year, I think is going to be about making all this a reality in our day-to-day portfolio management activity. To be honest with you, ESG has been much, we've been talking a lot about ESG over the past years, but now it is becoming concrete. But I'd like to take it a step further. So concretely, what it means is that I'd like to get more and more data in our front office system, in our reporting. I'd like all the PMs to get a better understanding of how you can target KPIs. So that's one, of the first topic on my agenda. Second, we need to get a better coverage so that we can increase our range of products. And where this is lagging at the moment is in high yield. It's where we've got merely 50% of the companies we invest in which are covered. Emerging market is roughly 70%, so it's not that bad, but we need to get an increase there as well. Asian fixed income to us is also very important. We see a lot of value there, but we need also to get more coverage, more data, and issuers in those regions or in those asset class to get a sense of how important this is for us.
Thanks a lot. And I also believe that we must start the production now. So we talk a lot about ESG. We still see that there is a gap between our goals and our wishes and that what we do. I think we can enhance the quality of everything, but it is good to start and to be familiar with it in the core investments and mostly also in the fixed income side as we discussed it today. So thanks a lot for your time. Thanks a lot for the very valuable insights, and we can hand over again back to Oliver.